Major tax changes are on the horizon for Americans, with significant shifts set to take effect after 2025. These changes stem from the expiration of key provisions in the 2017 Tax Cuts and Jobs Act, or TCJA, which was signed into law by former President Donald Trump. The TCJA introduced tax cuts for individuals and businesses, but many of these provisions were temporary and are scheduled to end on December 31st, 2025. Unless Congress takes action to extend these tax breaks or make adjustments, tax rates will revert to pre-2018 levels. This means higher taxes for individuals and businesses, changes to deductions and credits, and a shift in estate tax exemptions. With these potential changes just around the corner, it is essential to understand what's coming and how it could impact your financial future. The Tax Cuts and Jobs Act was one of the most significant tax reforms in recent history, affecting almost every American. However, while the corporate tax cuts were made permanent, the individual tax cuts were designed to last only until the end of 2025. This was done to keep the cost of the tax bill within budget rules. As a result, if Congress does not pass new legislation, tax laws will automatically revert to what they were before 2018. This means individual tax rates will increase, the standard deduction will decrease, and certain tax credits and deductions will either shrink or disappear. For businesses, small business deductions will expire, and certain tax-friendly policies will be rolled back. One of the biggest changes will be an increase in personal income tax rates. The TCJA lowered tax rates for most income brackets, but if these cuts expire, people will see higher tax bills. For example, the lowest tax rate, currently 10%, could increase to 15%, while the top rate may go back up to 39.6% from its current 37%. This change will affect all taxpayers, particularly middle-income earners, who benefited the most from the reduced rates. Another major change will be the standard deduction, which was nearly doubled under the TCJA. If it is allowed to expire, the standard deduction will shrink, meaning more people will have to itemize their deductions or face a higher taxable income. The return of personal exemptions, which were eliminated under the TCJA, could partially offset this change, but not enough to prevent higher tax bills for many families. Families with children will also see a shift in tax benefits. The TCJA increased the child tax credit from $1,000 to $2,000 per child, making it a valuable benefit for millions of parents. If the law is not extended, the credit could drop back down to its previous level, meaning parents will receive less tax relief for each child. The income eligibility requirements could also tighten, reducing the number of families who qualify for the full credit. Estate and gift taxes will also be affected. Under the TCJA, the estate tax exemption was raised significantly, allowing individuals to pass on up to $12.92 million as of 2023, without paying federal estate taxes. However, after 2025, this exemption is expected to drop back to around $5.5 million. This means more estates will be subject to taxation, and wealthy families may need to reassess their estate planning strategies. Many deductions and credits that were altered or eliminated under the TCJA will also return to their pre-2018 state. For example, the limit on state and local tax deductions could be lifted, which would benefit taxpayers in high-tax states like California and New York. However, other popular deductions, such as mortgage interest and charitable giving, could become less favorable for taxpayers if they can no longer benefit from the higher standard deduction. While individual tax cuts were temporary, corporate tax cuts were made permanent under the TCJA. However, businesses will still face significant changes as other provisions of the law expire. One major change will be the end of the 20% deduction for pass-through businesses, which primarily benefits small business owners, freelancers, and independent contractors. If this deduction expires, many small business owners will face higher taxable income, leading to larger tax bills. Another area of concern is corporate interest deductions. The TCJA placed limits on how much interest companies could deduct on their loans, but those limits will become even stricter after 2025. This could make borrowing more expensive for businesses, particularly for those that rely on debt financing for expansion. Research and development tax breaks are also set to change. The TCJA allowed businesses to fully deduct their research and development expenses up front, but after 2025, these expenses will have to be spread out over several years. This could discourage businesses from investing in innovation, as they won't receive immediate tax benefits. Bonus depreciation, which allows businesses to immediately deduct the cost of new equipment and machinery, is also set to phase out. Currently, businesses can deduct 100% of the cost in the year of purchase, but after 2025, this deduction will gradually decrease, making capital investments more expensive. While large corporations may not see a direct increase in their tax rate, these changes will still impact their financial planning and decision-making. Smaller businesses and startups, in particular, may struggle to adjust to the new tax environment. Whether these tax changes take effect will largely depend on Congress. If lawmakers choose to extend the TCJA provisions, some or all of these tax cuts could remain in place. However, the political landscape will play a significant role in determining the outcome. Given the divided nature of American politics, the future of tax policy remains uncertain. Taxpayers should prepare for the possibility of higher taxes while staying informed about any legislative developments that could alter the situation. With these potential changes looming, individuals and businesses need to start planning now. One of the best steps individuals can take is to review their tax situation and estimate how these changes might affect them. If tax rates increase, it may be wise to adjust retirement contributions, investment strategies, and income planning to minimize tax burdens. For families considering tax-advantaged savings plans, such as 529 education savings accounts or Roth IRAs, could help offset some of the financial impact. Estate planning is also crucial, as the reduction in estate tax exemptions could mean higher taxes on inherited wealth. Those with larger estates should consult with financial advisors to explore strategies for minimizing future tax liabilities. Businesses should also reassess their financial strategies. Small business owners may want to take advantage of the 20% pass-through deduction while it is still available, and companies planning major purchases should consider doing so before bonus depreciation phases out. Working with a tax professional is one of the best ways to navigate these changes. Tax laws are complex, and expert guidance can help individuals and businesses make informed decisions that reduce tax burdens and maximize savings. The tax landscape in the U.S. is set for major changes after 2025, with the expiration of the TCJA's temporary provisions. Higher individual tax rates, reduced deductions and credits, and shifts in business tax rules will impact millions of Americans. While political uncertainty remains, taxpayers should prepare now to minimize potential financial burdens. Staying informed and planning ahead will be key to adapting to these changes. Whether through adjusting investments, exploring tax-saving strategies, or consulting with professionals, taking action now can help individuals and businesses navigate the evolving tax system with confidence. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell so you never miss an update on important financial news. Let me know in the comments. How do you think these tax changes will affect you? Thanks for watching, and I'll see you in the next one.